Good morning. Today is going to be an interesting session because we are going to speak about life and death, illness, dysfunctional relationships, and also joy, and where all of that intersects with real estate. My name is Andy Norton. I am with Sampson Properties, and joining me this morning is Lori McNaughton of Atlantic Coast Mortgage, who is a reverse mortgage loan originator and also, dare I say, an oracle, a national expert in reverse mortgages, because you also teach classes to accountants and attorneys, financial planners, and realtors, correct? All the above?
That's correct.
Okay. Hopefully the intro is fair at this point.
If somewhat exuberant, yeah.
Okay. I think it's fair to say that maybe 2 people out of 100 could actually tell you what a reverse mortgage actually is. So to start, what is a reverse mortgage? And along with that, what isn't it?
Great. Thank you for that lead in. So a reverse mortgage in its simplest form is simply a home equity line of credit. And I like to compare it, I'm going to use some hand motions here, but I like to compare the home to a great big old-fashioned pickle jar filled up with pennies. And how did that pickle jar, which represents the home, how did that get filled up with pennies? Well, one of 2 ways. Either the homeowners have paid off their mortgage, or of course maybe they bought in cash years ago when the pickle jar was little, and now through home appreciation the pickle jar is big. So equity in this jar. All the reverse mortgage does is it simply takes the lid off the top of the pickle jar and it allows the homeowners to reach in and take out some of that equity as needs arise. Now, never can you pick up that pickle jar and dump out all the pennies. There always must remain an equity buffer in the bottom of that pickle jar. So this should sound like a very familiar concept. It should sound just like a home equity line of credit, because that's what a reverse mortgage is. So I always tell people, if you know nothing else about a reverse mortgage, remember a reverse mortgage is simply a home equity line of credit. It derives its name from the fact that rather than being repaid monthly, it's repaid on the back end in reverse when you no longer need the home. So when the home is sold, the loan is repaid on the back end in reverse. The rest of the equity belongs to the homeowner, to the heirs, or to the estate. And the issue, of course, then becomes, or the question should become, to any thinking individual, the question should become, if it's a home equity line of credit, why not just do a home equity line of credit? And the reason is the repayment. So if you are cash flow challenged, as many people become during the retirement years, with a regular home equity line of credit, you take money out, but then at month's end, you have a mortgage repayment, and that really stresses a lot of budgets. So with a reverse mortgage line of credit, you can take money out, take more money out as needed, and not have that month's end repayment obligation.
Okay. If everything was as simple as it sounds at first blush, your life would be much easier. But you have one of the more difficult jobs among people that I've met in the real estate space. So let's talk about how some of this can be complicated. With a reverse mortgage compared to a forward mortgage. Actually, let's contrast that with a forward mortgage for a second. Because with a regular mortgage, what I'll call a forward mortgage, you make a payment on the first of the month. Part of it goes to principal, part of it goes to interest, and over time the balance goes down. With a reverse, you're not making payments each month.
You're not required to make payments. So I would refine that a little bit and say you're not required. Now I have about, I would say a significant percentage, maybe 25% of my clients do opt to make a payment. And the reason Andy's comment is so significant is, so we're going to go back to the image of the pickle jar, and let's say the car someone is driving is inappropriate. They are now using a walker following an accident. They can't fold up their walker and get it into the back seat of their current car. They
Right.
need to sell the car, get something with a bigger back seat or a door that opens more widely. And so they need, let's say, $30,000 to buy this car. They decide they don't want payments, they just want to buy the car. So out of that pickle jar, they take $30,000, buy the car. Now, there is, a lender is just a money store. We simply sell money. And anytime you sell anything, there's profit margin in banking
Right.
that is called interest. So the profit margin on money is called interest. And so you take out that $30,000, but there's interest that we will get back on the back end. And so that interest is accruing. And then let's say you need another $10,000 for unmet medical expenses. So you take that out, and there's interest on that as well. So there is no required mortgage payment, but if you want to pay just the interest on this loan,
Right.
several things happen. First of all, it keeps the loan balance from growing. There's no interest accruing. But also, if you're still paying income tax, you can use that payment as a mortgage interest deduction on your taxes. So that's a benefit. But then the other thing is, if you put money into the pickle jar, and then need that money back out again, you can take that back out. So with a traditional 30-year mortgage, we'll use a 30-year because it's the workhorse of the mortgage industry. For about 22 years, you pay either strictly or largely interest. Pay interest, and then the last 8 years, you make serious headway on the principal, and then 30 years, you've got the whole thing paid off. So 22 years, this isn't exactly cut and dried, of course, because we know it starts to transition, but largely interest for 22 years, principal for 8 years. With a reverse mortgage, you're not paying principal, nor are you paying interest. Interest and principal typically are repaid on the back end. However, there are these other stratagem you can use where you're paying the interest, holding the balance steady, and you get a mortgage interest deduction on your taxes,
Right.
and you can pull it back out again.
So if I heard you right, 25% of the people choose to make a payment,
Yes.
which
Yes.
means, by my inexperienced real estate math, 75% do not.
Correct.
Okay.
Correct.
So,
And-
go ahead, I'm sorry.
Oh, I was going to say, you suggest actually an interesting topic, so I'm answering a question you haven't yet asked, so I'm
Okay.
maybe reading your mind. But it tends to be very age group specific. The person who is making that interest payment tends to be a discrete age group. So my clients, most of them, so there are non-FHA products. They're so-called jumbo reverse mortgages. Those are for people 55 years of age and older. I'm actually going to leave those off from this discussion and just talk about the people
Right.
doing an FHA reverse mortgage who are 62 years of age and older. So a very discrete cohort tends to be for those in the age group from 62 to about 74. So that's the younger cohort. And then 75 up to 80, and then 80 and on. And it's that younger cohort who tend to still be working and still have significant assets under management. And that cohort is the group typically who is making payments. Then when they transition into the middle cohort, they've stopped working. A lot of times health issues start to become more pronounced. And at that
Right.
point, they say, you know what, I need all the cash flow, I'm not going to make the interest payment. And then that interest just sits there and will be repaid upon sale of the home.
Okay. And all of that's well and good, except, so let's
Okay.
start getting into maybe one of the reasons you might even need to speak to a financial planning group. Just last night, I was speaking with a potential future client for you, talking about reverse mortgages and about adult children of seniors. And that in a forward mortgage, month by month, the mortgage is being paid down, right? So month by month, the equity is growing, so that month by month, the future inheritance of the adult children is growing.
Yes, undeniably.
As opposed to, and you know where I'm going with this because you deal with this all the time, as opposed to on a reverse mortgage, if they're not making that payment month by month, and 75% are not, then month by month, if one is looking at this cynically from the point of view of an uncaring adult future heir, month by month on a reverse, is it not true that their future inheritance is going down?
It is true. It is true that the equity, mom and dad, so we're going to, in this scenario, we're going to run it as though it's a very common scenario. So we're going to call this mom's house, and we're going to call the homeowner mom.
Yes.
So the adult child, excuse me, as I understand it, the scenario you're painting, the adult child is becoming resentful because mom is using the equity in her home for herself as opposed to leaving it untouched and leaving it to, bad daughter or
Right.
Yes, anticipatory, yeah.
Anticipatory inheritance.
Daughter, yeah. So here's the thing. Here is the thing, and I have spoken extensively on this, I've written extensively on this, and I call it the true cost of bankrolling mom. So there's one of two ways to go. If mom is doing a reverse mortgage and is indeed using her line of credit, clearly she is cash flow challenged. A lot of times this is health driven, but it could be other things as well.
That's right.
So let's spin this thing the other way. Mom does not do a reverse mortgage. Mom is cash flow challenged. Things are going to start happening. She's going to become late on her homeowner's insurance, or she's going to be late on her property taxes, or she's going to put charges on a credit card. And then if things get bad enough for mom, guess who's up to bat?
Yeah.
The hopeful heir.
The hopeful
heir
heir
is going to step in and start bankrolling mom.
Yes.
So this is how things have rolled for, we take care of our parents, our older parents. Even
Ideally.
Ideally, yes.
Yeah.
So let's say daughter has indeed stepped in and has started bankrolling mom. What is this costing daughter? Well, first of all, she can't claim those gifts on her taxes. That is money, hard-earned money she is not putting into her own 401k. And it is unlikely, let's say mom's line of credit was going to be $350,000. It is unlikely the daughter is going to have disposable income enough to pay mom $350,000 over the course of the next number of years. So there is a concept called self-pay to the end of life. So optimally, what a reverse mortgage is doing, it is enabling mom to be self-pay to the end of life and getting the daughter off the hook from bankrolling mom. Now it could be that the daughter eventually, if mom goes through her entire line of credit, the daughter does step in and bankroll mom at some point. But that's far fewer years that she's had to step in than had mom not had this pool of funds to use during her retirement years.
And hopefully what you just explained would be something a financial planner or an accountant or other advisor would tell this adult child, because so often the senior goes to the adult child with respect to important financial decisions like a reverse mortgage and says, kids, what should I do? And then they tend to follow the advice of either the adult kid or the financial advisor.
And that tends to be age cohort specific as well, because the younger cohort, again, the 62 to 74-ish cohort, they tend to be very independent. And there are times where I have people say, because I always ask if they have family members that they'd like to draw into the discussion. And sometimes it's like, yeah, I've got 3 great kids, but I don't need them knowing my business. And I understand that. I would still encourage them to have that money talk with their kids. But then the other 2 cohorts, the 75 to 80-year-old and then 80 and older, many of them are very reliant upon advice or just collaboration, advice from or collaboration with their kids.
Okay. So speaking of the different age cohort, am I correct that if you're in a younger age cohort and you have the line of credit, and you don't have a medical need yet, you do have flexibility about how you could spend that money? So that if, for example, a younger senior wanted to buy a Tesla with all the bells and whistles, could they do it?
Oh, sure. There are no restrictions. It's your money. No restrictions placed upon how that money is used.
Ideally, they would be replenishing the piggyback at some point, but they don't have to. They could be wasteful, irresponsive, and profligate if that were their choice.
Inclination. Yeah, and now I will, yes. So the simple answer is yes.
Okay.
Yes, you could be an absolute spendthrift, spend down all that money. But I would add a coda to that, to my own comment, which is I have never seen that. I have never seen anyone in their retirement years engage in profligate spending.
Okay.
So it probably exists out there. I just haven't encountered it.
Okay. Let's talk about what can go wrong with respect to the borrower, the family, and the bank. At the end of life, the loan has to be paid off. So if the family has the money they could sell it and they could pay off the reverse amount due at that point. But if we go through another cycle, hope we don't, but if we go through another cycle where property values are declining and there isn't enough money on sale to pay off the reverse, then what happens? It goes to the bank, the government pays.
Okay.
How does that work?
All right, so you're actually asking about 4 different questions. So we're going to unpack this and just kind of
Please.
walk through. So there are, we're talking about the back end of a reverse mortgage. So for argument's sake, we are going to, we'll paint 2 scenarios. So mom has passed away in this scenario we're going to address. So mom has died, the home now stands empty. And there's one of 2 things. Either the home still has equity in it, or if the housing market has declined, the home may have no equity in it.
Correct.
That could be an outcome. So if the home has equity in it, then the kids have several options. Excuse me. They can sell the home, which is indeed what happens in 95% of the cases.
Right.
You know, by the time mom dies at 92, the kids are 70, they don't want mom's house. But they sell the home, the loan is repaid, the kids get the rest of the equity. End of story. Right. Sell the home, the loan is repaid right off the closing disclosure, the kids get the rest of the equity, assuming mom has not cut them out of her will.
There is that. There is that, yes.
There is that. But that's a different issue altogether.
Yeah.
It's a legal issue I have no role in.
Yeah.
But so that's traditional. But if the kids do want to keep mom's house, then they need to either repay in cash. So we're going to go back to the image of the pickle jar. And let's say mom has used that much. So I'm just going to assign it a number. Let's say mom's used $200,000 and the home, we'll put it in this area. Let's say the home is worth $800,000. Mom's used $200,000. The kids can repay that debt in cash if they want, or they can secure their own mortgage and just refinance that debt into their own name. Then they've got the house, end of story. Now, let's say, first of all, mom hasn't died. So we're going to do same scenario, $800,000, $200,000 due. Mom hasn't died, but mom does have to go into a care community. So she has to, I'm just going to use old-fashioned shorthand, say a nursing home. If mom is out of the house full-time for more than 1 calendar year, at that point, the kids need to decide what they're going to do with the house.
Correct.
When mom's been out of the house more than 1 year, the odds drop to just about nothing that she's coming back home. So
right.
Again, the kids will sell the house, or the kids will pay back the loan, or they'll refinance that debt into their own name. But your scenario is much more complex, where you had said the housing market has crashed. And so now mom has $200,000 due on the mortgage. And in this scenario, again, we're going to say mom's passed away.
Right.
Home was worth $800,000 at the time of origination, and now the worst has occurred. Mom still owes $200,000, but now the house, the pickle jar has shrunk. The house has gone down in value to the point where selling the house, the proceeds from selling the house can't repay the loan. So what happens? And let's assign the home a value. We'll say the home has gone down to $100,000.
That's
okay,
right.
That's unlikely, but we'll pretend.
Okay, for discussion purposes.
Yes, so $100,000 asset, $100,000 home, $200,000 mortgage balance. So first, what happens with a traditional forward mortgage is the following. The lender will put a judgment against the estate, and they will try their hardest to collect. They'll come after any other assets. They'll do whatever they can to get their money back. That is not what happens with a reverse mortgage. What happens with a reverse mortgage is the home will still pay back whatever it can, in this scenario, $100,000, and then the mortgage insurance, the FHA mortgage insurance, pays off the rest. And the wording says no deficiency judgment can be assessed against the homeowner, assuming he or she's still alive, the heirs, or the estate. So in other words, everyone walks scot-free if the home goes down in value. Home will repay what it can. The mortgage insurance covers the shortfall regardless of why that shortfall occurred.
Okay, and thank you for that. Let's transition into another interesting reverse mortgage scenario called a reverse for purchase, because a senior is actually able to purchase a home with a reverse mortgage, and then thereafter, as long as they pay the taxes and the HOA and maintain the property, not make mortgage payments again until they either die or go into a care facility or whatever. Tell us about a reverse for purchase, because most people don't even know that you can do it.
Sure, and I always like to start off with a funny personal story, kind of an embarrassing personal story. But I had been doing reverse for purchase for no insignificant amount of time. And then FHA rolled out reverse for purchase. And I absolutely could not wrap my head around how reverse for purchase worked. But now it seems so straightforward that I can't remember what I couldn't remember or couldn't understand. But
yes.
So I'm looking around for a little, so we're going to use this. We're going to use this little card here, this little placard. So mom and dad are in this house. And lovely home, it's where they've been for 50 years, but it's those darn stairs. The house is just not working for them.
Correct.
They need to get into this home, so single level living. So they typically, this is how it rolls, so we'll paint a different scenario here in a second. They sell this house, Andy sells this house, they put that money in the bank. And let's say for argument's sake, when all is said and done, they put $700,000 in the bank.
Right.
And now they find this home, and let's say this home is $600,000, single level living. They find $600,000 home. They've got $700,000 in the bank. Obviously, they could have paid in cash. They could have paid in cash. If they did pay in cash, they've turned $600,000 of liquidity into illiquidity. So what reverse for purchase does, well, and the benefit from paying in cash is they've got no mortgage payment. But they've also got no cash. Now they're house rich, cash poor. So with reverse for purchase, they will bring a down payment, which is larger. Frankly, it's larger than a typical down payment. It's going to be about 50%. The loan amount makes up the rest. So down payment plus loan amount. I call this the big no duh. That's how any mortgage works. Down payment, loan amount.
Yes.
And they're done. They've made the only payment on that home they'll ever make. When the last person on title permanently vacates the home, so either goes into a nursing home or passes away, the home is sold, the loan is repaid on the back end in reverse, the kids get the rest of the equity, including all appreciated value of the home. So two ways traditionally, put this little thing back, two ways traditionally people buy a home. They take out a mortgage or they pay in cash. If they take out a mortgage, and let's say they're 70, they're going to be paying for the rest of their natural life. And here becomes the issue. If dad dies or if one of them dies, the survivor has all the debt and half the income. All the debt and half the income. And just the way the world works, it's likely to be mom is left to pay that mortgage. She's got all the debt and half the income. And it can be really a dire financial situation. If they pay all cash, again, they've got no mortgage payment, but they've got no cash to live on. So reverse for purchase is a perfect wedding of those two concepts. Down payment, so you have a mortgage, which means you've got more money in the bank. But you also have no mortgage payment. So money in the bank and no mortgage payment. And there's literally nothing else that affords that particular blend of retain more liquidity from the sale of the exit home and have no mortgage payment.
Another thing that we should definitely cover, because I'm sure many people watching this say, okay, it sounds too good to be true. How do people qualify for a reverse mortgage compared to qualifying for what I'll call a regular or a forward mortgage. What's involved
Okay.
in that?
All right, all right. And I used to be a teacher and a chemistry teacher, so I think I analyze things maybe a little too deeply. But you actually asked two questions: too good to be true, and how do you qualify? So we're
Yes.
going to look first at how you qualify. So for the FHA, the product we've been talking about, you have to be 62 years of age. Just one of the couple has to be 62 years of age or older. And then you have to have monthly income enough to pay your property taxes, your homeowner's insurance, and then have residual income left. And for a married couple, it's $886 left at month's end after you've paid your taxes and insurance. For a single person, it's it's $529 left at month's end. So most people, I would say, qualify just on their Social Security. Can they pay their taxes? Can they pay their insurance? Do they have cash left at the end of the month? But as far, and for purchase, for reverse for purchase, which we were just addressing, we have to show they've got that down payment. And usually, as I say, it's usually derived from the sale of the exit home, although it can come from any source, including gift monies from adult children or even friends. So now now I'm going to transition into did that sufficiently answer your question? How do you qualify?
Absolutely, thank you.
Okay, all right. So, and I'm going to add a little bit of extra commentary. Why can you qualify for a reverse mortgage when you can't qualify for other mortgages? So a lot of times I'll have forward loan officers call me up and say, I've got Mrs. Smith here. I can't qualify her for a forward mortgage. I was wondering if she'd be a good candidate for a reverse mortgage. So why can I qualify someone when a forward loan officer couldn't? And do you want to take a stab at that?
So to the best of my knowledge, that the reason that you can and a forward mortgage can't is that the borrower is not really qualifying. It's the property that they're purchasing that's qualifying.
I could see why you would think that. That's actually
that's not true?
Quite. That's not quite
quite
right. So if you do a forward mortgage, so you just go into the bank, take out a forward mortgage, or try to take out a forward mortgage, the loan officer has to prove you can make a mortgage payment for the life of the loan. You have to show you can make that mortgage payment. If you're living on, let's say you're living on $1,800 a month in Social Security, and you're trying to take out a line of credit, and the repayment obligation is going to be $800 every month, leaving you $1,000 to live on, you're not going to qualify for that mortgage. It's not the property, it's not the borrower. She may have great credit. It's that mortgage payment she is not able to fund, so she
Right.
can't make that mortgage payment. With a reverse mortgage, line of credit, but there's no mortgage payment. So the reason I can qualify someone for a reverse mortgage who could not qualify for a forward mortgage is I do not have to demonstrate she can make a mortgage payment. The house will repay what the house owes when she no longer needs the house. So, so yes, that's it. But the property does have to be, it has to be a sound property. So there is an inspection, or rather an appraisal.
So speaking of soundness of properties, because this is going to vary as you go across the country, and different markets are more expensive than others, and our market here in the Washington area tends to be more expensive than others, is there a limit on the amount of reverse mortgage? Could it be $1 million house with a $500,000 down payment? Could it be a $2 million house with a $1 million down payment?
Got it. So you're
Yeah.
talking about reverse for purchase.
So
So
reverse for purchase.
Yes. So so again, I'm sorry.
I'm asking multiple questions.
Yes. So
I do
the
that.
size of the down payment is a function of the younger homeowner's age. So if mom's 70 and dad's 72, we're going to look at mom's age, 70. The size of her down payment, I can get my handy little thing here again. So the size of mom's down payment is a function of her age. So at 70, she's going to bring about 50% to the table as far as the down payment goes. So your question was,
If they want to buy a more expensive
house.
property. Yeah.
Sure. So let's say she buys $1 million property. Can we do a loan on that? Absolutely. She's going to bring half of that to the table. She's going to bring. They are going to bring $500,000 to the table. That does include closing costs, so that when I tell somebody their down payment, that includes the closing costs. Now, a $2 million property, they're going to bring more because I can only lend up against, I can't remember what the new number is, $1,089,000 or something. I can never lend $1,089,000. I can lend a percentage of that based upon the homeowner's age. So if they're going to buy a $2 million property, the most I can lend is a percentage of $1,089,000. So certainly they can buy that $2 million property, but it's going to be, I can lend about $500,000, but they've got to cover the rest. So they bring a bigger down payment, but it still means that there was $500,000 of that purchase they didn't have to bring to the table.
Okay.
Did I make that clear?
That answers it. Thank you very much, both for that question and also for enlightening us on the entire range of issues that affect reverse mortgages. Lori, thank you for being here this morning.
Great being with you.
Okay.